I've been worried that the accumulation of all of these debts would ultimately lead to dollar. The only question is, how long is this process going to take now to complete? How did you go broke? Well, it was gradually and then suddenly.
Be careful what you wish for. They're going to get lower rates. Rates are going to come down a lot, but that's usually associated with a recession and depression.
What could have done better? What didn't they do? And what would have been the possible outcomes?
Well, what we're saying with the accumulation, well, first of all, people don't really understand reserve composition. They say the dollar is the leading global reserve currency. Actually, no. Dollar-denominated securities are the leading reserve asset. It's not as if the People's Bank of China has pallets of $100 bills in the basement. They don't. They own U.S. Treasury securities. So you don't actually own dollars. You own securities that are denominated in dollars.
Yeah, so they own mortgage-backed securities. They own corporate bonds. It's not all U.S. Treasuries.
Correct.
They have a lot of other dollar-denominated assets.
That's correct. U.S. Treasury securities are dominant, but you're right. They have a lot of other things. You could have Japanese government bonds, German government bonds, or stocks. The Japanese Bank of Japan owns the Japanese stock market practically. So that's correct. But U.S. Treasuries are the number one asset. But my point is, they're U.S. Treasury securities. They're not it's not cash. So if you need cash, you have to sell the treasuries to get cash. Why would you do that? In the case of China, to prop up your currency or prop up your banks, which have enormous dollar-denominated bad debts that are not going to be repaid. So they need cash to stay afloat. So the point is, it's just a fact. The Treasury issues a monthly report. It's a very simple spreadsheet, lists all the major countries and how many U.S. Treasuries they own by maturity. So that's all publicly available data. There is no evidence that countries are dumping U.S. Treasury securities. It's just not true.
Yeah, no one is dumping them, but they're not buying the way they were, which means we're dumping them. Because if we don't have foreigners to buy our treasuries, somebody's got to buy them.
Well,
and in fact, we used to also have the so-called Social Security Trust Fund was a big buyer. Mm-hmm. Now they're a seller.
Correct.
Right. So who's buying these treasuries now? Private investors. I don't see the appetite for long-term 4% yielding treasuries. I mean, it's pretty obvious that that's not going to beat inflation, especially after taxes. And so people would rather invest in stocks. They'd rather invest in real estate. They'd rather buy gold. So you don't have the buyers. And, this de-dollarization, I mean, I've been talking about de-dollarization for 20 years, but that's, been my investment thesis. That's why I've been putting people into gold since it was under $300 an ounce. I've been investing predominantly in foreign stocks because I've been worried that the accumulation of all of these debts would ultimately lead to dollar prices and an end of the dollar's position. And until recently, nobody else was even talking about it. So the fact that now all of a sudden people talk about de-dollarization, I think that, yes, it's been a risk for a long time that nobody was cognizant of. And the reason they're cognizant of it now is because it's actually a lot closer. And it's a lot closer than people think. I think now that central banks recognize, okay, this is real. And I think maybe electing Donald Trump may have been another catalyst. Not only did he basically vilify all of our friends that are propping us up by running these consistent trade surpluses with the United States, which helps us live beyond our means, but imposes a burden on the world to finance it. But not only did we kind of vilify all of our friends, but, the deficits really exploded into a whole new trajectory, with COVID. And that started with Trump. It didn't start with Biden. Trump started the PPP and all the COVID stimulus. Biden just continued what Trump had already put in place, right? And expanded it. But so when we took our deficits from, whatever they were, 600, 700, 800 billion a year up to 2-3 trillion a year, right? And then when the Republicans campaigned and said, okay, look, this has got to stop. We got to rein in government spending. We have too much inflation. It's because of government spending and all the stimulus. And
before we go any further, I want to know what you think. Do you believe the US dollar will remain the world's dominant currency for the next decade? Or are we witnessing the early stages of a major shift? Drop your opinion in the comments below. And if you enjoy deep discussions about gold, inflation, debt, and the future of the global economy, make sure to subscribe and turn on notifications, because the next few years could change everything.
We need to cut government. And then you have Elon Musk. Yes, we're going to have the Department of Government Efficiency. We're going to cut trillions out of the budget. So there was all this big talk by the Republicans that we're going to really get our fiscal house in order, right? And then when they get elected, the first thing they do is this big, beautiful bill, which preserves all of the Biden deficit spending and then adds to it. And they run Elon Musk out of town after parading him around for a little bit. None of the cuts actually happen. It's all a bunch of nonsense, right? And now we're running, $3 trillion a year deficits. They claim it's 2, but if you just look at how much the national debt is increasing every year, it's more like 3, because there's a lot of off-budget stuff that they don't count as part of the official deficit. But we still have to borrow that money because we're still spending it, even if they don't want to account for it. And this is when the economy is supposedly in expansion, which means that when we have the next recession, which of course is inevitable, we're $5 trillion deficits. Where are they going to be? And so now the world recognizes, look, if even the, MAGA Republicans, Trump, if they're not going to do anything, we know the Democrats aren't going to do anything about it. They're going to spend more money. So there's no hope. There's no party left that has any sense of fiscal responsibility. And in fact, what is Trump advocating now? He wants interest rates slashed, which reduces the yield on your US dollars. He wants the Fed printing more money, and he's going to stack the Federal Reserve Board with his cronies to make it possible. Just like Roosevelt tried to pack the Supreme Court, he's putting people at the Fed that will basically do what he wants, destroying even the pretense that the Fed is independent. And so that really destroys confidence even further in the long-term value of U.S. currency. So I think that what I've been worried about for a long time is happening. And the only question is, how long is this process going to take now to complete? There's that old saying, how did you go broke? Well, it was gradually and then suddenly. And, we could be very close to the suddenly part.
Peter and I agree completely on gold, so there's no daylight there. We might disagree a little bit about the bond market. I would point out that the yield to maturity on the 10-year Treasury note has been in a very narrow range for over a year. It's between 4 and 4.25. It's kind of like 4.1 today. I expect it'll go a lot lower. In fact, I like that trade, but buying 10-year Treasury notes is a little bit volatile, but you could have huge capital gains if that makes its way down to 2.9 or whatever. The DV01, dollar value of 1 basis point decline, is bigger as you get at lower.
But what will drive the yields down?
Well, kind of what you were referring to, Peter, which is, when you mentioned the Federal Reserve, it's hard to think of an institution that's less relevant than the Federal Reserve. They're impotent and irrelevant. They mean almost nothing. They get all the headlines. I follow them closely because everyone else does. And if you want to, be informative, you have to know what they're doing. But they're actually irrelevant. And I'll give you a couple data points to support that. The Fed targets the Fed funds rate. You know what? There hasn't been a Fed funds market since 2008. There's a little bit of a market, but they're targeting something that almost doesn't exist. There are 2 substitutes, 2 unsecured, very short-term, very liquid markets that approximate what the Fed funds rate is supposed to do. One of them is the 1-month Treasury bill. 1 month, not 1 year. It's very liquid, very safe, very low volatility. You buy it, you get your money back in 30 days, 31 days. The other one is called the secured overnight financing rate. It's basically the repo rate. Fed kind of came up with their own measure. But that's, again, overnight. It is secured, but it's highly liquid. It's how dealers finance themselves and how hedge funds finance their position. So 1-month Treasury bills and the secured overnight financing rate today are both lower than the Fed funds target rate. So the Federal Reserve is not leading anything. They're following the market. The market is already lower than the Federal Reserve target rate. Now, the Fed's going to cut again, and probably several more times. And Peter's right. Trump's going to stack the board. And he's, halfway there. He's got 3 governors and a couple more on the way, I expect, including a new Fed chair next May. But the point is, my advice to the White House is be careful what you wish for. They're going to get lower rates. Rates are going to come down a lot. But that's usually associated with a recession and depression. Low rates are not stimulus. The idea that low interest rates stimulate anything. You know what a healthy economy looks like? And Peter referred to this earlier. A healthy economy has like 4 or 5% interest rates, because that means I can borrow at 5%, invest at 10, leverage 2 to 1, make a 20% return on equity.
What makes this debate so important is that both sides agree on one thing. America's debt problem is real. The disagreement is about what happens next. Will lower interest rates save the economy? Or will they simply signal that a much larger recession is already on the way? That's the question investors around the world are trying to answer right now.
Hire people. That's what a healthy economy looks like. A 1% interest rate is something associated with the Great Depression. So we're going to get there, but we're going to be in a severe recession, and people are going to be very miserable. Unemployment's going to be a lot higher, and this would certainly threaten the Republican position in the House in the midterm elections. So again, my advice to the White House is you're going to get your lower rates, but you're not going to be happy when
I agree with you,
because it's a sign of recession.
We could get lower short rates, but what is the impetus for lower long-term rates? Who is going to buy that paper to drive yields down? And where's the money going to come from? Because if I'm buying U.S. Treasuries, I can't buy something else. So where is money going to flow from? And why is it going to buy Treasuries at less than 4%? If you're talking about a big capital appreciation,
right,
you're talking about Treasuries yielding 3%.
Correct.
Or 2%. Who's going to want to loan money out to the U.S. government for 2-3% over 10 years?
Well, one phone call from the Treasury to Jamie Dimon will fix that in a hurry. Banks used to have between 40 and 50% of their assets in U.S. Treasury securities. Today, that amount is under 10%. So there's a lot of room in bank balance sheets now.
But what are they going to sell, though, to get that money?
They can print it. That's the thing.
The banks?
The banks print money. Yeah, the Federal Reserve printing is irrelevant. People go, how does the Fed print money? You know this. Mm-hmm. So the Fed basically calls the open market desk in New York, calls Goldman Sachs and Morgan Stanley, said, offer me 5-year notes. They offer them done. The banks send the 5-year notes in, and the Fed pays for it with money that they print. That is true. Right. That is printed money, and it does expand the balance sheet. But what do the banks do with the money? They give it back to the Fed in the form of excess reserves. You're inflating both sides of the balance sheet. That money doesn't do anything. It doesn't get lent, it doesn't get spent, it doesn't get invested. There's no velocity, et cetera. It just sits there, and you have an expanded balance sheet. That's why the Fed's irrelevant. Now, where does the money come from that is relevant, that does support business, create jobs, drive the economy, et cetera? It comes from the banks themselves. Commercial banks, this is why they own the Fed. Commercial banks create the money, and they can create money to buy Treasury securities if they're called upon to do so, and they will. I mean, you can't, every seller has a buyer. I mean, you can say there aren't any buyers. Actually, a lot of buyers. Question is the yield. I agree with that.
But if they do
sorry to interrupt, but the bond vigilantes, I was around when they saddled up the first time. They're all retired. They haven't saddled up since the late 1980s. Maybe the early 90s would be the last time we had to worry about bond vigilantes.
If all this money gets created then to buy Treasuries, the government's going to take that money and spend it right into circulation, and there's inflation. So at the very time that long-term yields are rising,
right,
you're having inflation, which is already well above their so-called 2% target, rising. So in what world, let's say, do you have even official inflation? Let's say it's running at 5 or 6% or 7%, yet you have long-term debt yielding 3%. I mean, obviously there can't be a real buyer there. Nobody is going to deliberately throw away their money knowing that inflation is taking 6% away per year, and they're going to accept half of that back in return and just sign up for a decade of losses.
Well, if you posit the inflation, you're exactly right, but that may be where you and I disagree. I see us heading for disinflation and perhaps deflation. My point is the 4% yield on a 10-year Treasury note could look pretty sweet in a world of 2% or 1% interest rates. That's going to look very,
right, but it's not going to look sweet if inflation is much higher than that.
That's right.
And I think, based on where we are now, I mean, they were able to get away with QE before because inflation was, the way they measure it, below 2%. And the world was buying. When you wrote your book, Currency Wars, when we did QE 1 and 2 back then, foreign central banks were buying up all our debt.
Yeah.
And they were basically worried that their currencies were going to be too strong. And they were basically trying to, debase that was the war, to battle, keep your currency down.
Currency wars, yeah.
They were afraid that the dollar was going to lose, and they didn't want their currency to go up too much. I don't think we're in that world anymore. I think that if we start printing a bunch of money, there aren't going to be buyers for our treasuries in foreign central banks.
Think about what we've heard so far. If governments continue running massive deficits, if central banks keep accumulating gold, and if confidence in fiat currencies keeps eroding, then the financial system of the next decade may look very different from the one we've known for the last 50 years. And that's exactly why this conversation matters.
And so I think that the dollar is going to lose a lot of purchasing power relative to other currencies, and that means our import bill goes through the roof, and we're more dependent on imports now than ever before. Despite these tariffs, we're running record trade deficits in manufactured goods, and so when the Fed tries to do QE again, it's just going to backfire because the dollar is going to go down, prices are going to go up, gold prices are going to go up even faster, and that's the dollar competes with gold, and so why am I going to loan the U.S. government money at 3 or 4% if gold is going up 30-40% a year? I mean, I'm giving up. I'm going to own gold. I'm not owning those treasuries for 3%. When I'm going to buy gold. So I think we're at a point where it won't work if they try. That's why I think, and this is one of the forecasts that I made that came true. But before the Fed embarked on the rate cuts, towards the end of Biden's term, and the Fed cut rates for the first time after, they'd been hiking them for a year and a half, and they got up around 5%. And when they started cutting rates, and the forecast that I had been making for the whole year leading up to that was that the minute the Fed started cutting short-term rates, that long-term rates would rise. And nobody really had that forecast. I mean, in the mainstream, everybody expected that long rates would go down with short rates, just like it had in the past. And the Fed went, they did 75 basis points of cuts, and long-term rates went up by that amount. Not only did they not go down, they went up by as much as the short rates went down. And that, surprised everybody. They didn't really expect that or understand that. But it didn't surprise me because that's what I was expecting. And I think that was an indication that the Fed is now in this predicament where when they lower rates some more,